Every year, thousands of smart founders walk into rooms full of capital and walk out empty-handed. Not because their ideas were bad, but because they misunderstood how investors actually decide. They teach most people how to earn money, how to save money, and sometimes how to invest money. What they rarely teach is how investors actually think. That gap is the reason many people have good ideas, but never attract capital. Investors are not impressed by passion alone, and they are not persuaded by effort. They operate from a framework built on risk, probability, incentives, and scale. In this video, we are stepping inside that framework, not the television drama of Shark Tank, but the real decision logic behind why sharks say yes, why they say no, and why some deals become billion-dollar outcomes while others collapse despite early excitement. By the end of this breakdown, you will understand how Shark Tank investors evaluate opportunities in practice. You will learn how they assess problems, markets, founders, traction, valuation, defensibility, and exit potential. You will also see how real Shark Tank deals such as Scrub Daddy, Bombas, Ring, and Breathometer reveal patterns that apply far beyond the show. This is not about pitching better. It is about thinking like capital. You will learn how professional investors filter opportunities under uncertainty, why numbers matter more than stories, how founders signal competence through behavior, and why investors care less about certainty and more about asymmetric outcomes. This content is for educational and informational purposes only and does not constitute financial, investment, or legal advice. Examples discussed are for learning purposes only. Investment outcomes vary, and past performance does not guarantee future results. Always conduct independent research or consult a qualified professional before making investment decisions. The first thing sharks evaluate is not the product, it is the problem. Products are replaceable, problems are not. Investors ask whether the problem is real, painful, urgent, and expensive enough that people are already spending money to solve it. If customers are not actively paying for alternatives, the opportunity is weak, regardless of how innovative the product appears. Scrub Daddy illustrates this clearly. On the surface, it was just a sponge. What made it investable was not novelty but utility. Cleaning is a recurring, unavoidable activity, and the product performed better than existing options. Lori Greiner invested because the problem was universal, the solution was simple, and repeat purchases were inevitable. The success of Scrub Daddy was not accidental. It aligned with existing behavior and spending patterns. After the problem comes market size. A business can be profitable and still be unattractive to investors if the market is too small. Sharks are not evaluating whether a company can survive. They are evaluating whether it can scale meaningfully relative to the risk they are taking. This is why sharks often say they like the product, but are out due to the size of the market. Bombas is a clear example of how market size changes the equation. Socks are not exciting, but they are universally consumed. Damon John understood that Bombas was operating in a massive apparel market with room to expand beyond its initial product. The buy one, give one model added emotional appeal, but the underlying opportunity existed because the market itself was large and expandable. Investors do not need excitement, they need room. The next layer is the founder. Sharks invest in people because people execute ideas. They evaluate how founders think under pressure, how they respond to criticism, and whether they demonstrate clarity and resilience. Confidence alone is not enough. Investors look for composure, logic, and adaptability. This is why sharks often say they are investing in the entrepreneur rather than the product. A strong founder can pivot when assumptions break. A weak founder cannot survive volatility. Over time, execution matters more than originality. Traction is where theory meets reality. Sharks place far more weight on evidence than on forecasts. Revenue, customer retention, and growth trends reveal whether the market agrees with the idea. Even small but consistent traction signals demand, discipline, and operational capability. Kin Apparel demonstrated this principle through real sales driven by organic demand. The business did not rely on projections or hypothetical customers. It showed that people were already buying. For investors, this reduces uncertainty. Behavior is more trustworthy than intention. Valuation is the next filter, and it serves as a psychological signal. Overvaluation suggests that a founder does not understand risk or dilution. Undervaluation can signal desperation or lack of long-term thinking. Sharks are not searching for bargains. They are searching for alignment. Valuation reflects how a founder understands ownership, growth, and partnership. Defensibility separates businesses from short-term opportunities. Sharks want to know what prevents competitors from copying the idea and eroding margins. Defensibility can come from brand, distribution, technology, cost advantages, or network effects. Without a moat, competition eventually compresses returns. Ring provides an important lesson here. The Sharks passed on Ring during its pitch, but the company later built defensibility through product evolution, ecosystem integration, and brand trust. Amazon eventually acquired it for over $1 billion. The lesson is not that sharks were foolish, but that defensibility often develops over time. The framework remains valid even when outcomes surprise. Exit potential is always present in the background. Sharks are not investing to collect salaries or manage small operations. They are investing for liquidity events. They evaluate whether a company could be acquired, merged, or taken public. If there is no plausible path for capital to exit at scale, the opportunity is unsuitable for their model. Breathometer demonstrates the final and most uncomfortable truth. All 5 sharks invested heavily, and the deal later failed due to execution and regulatory issues. Mark Cuban publicly acknowledged it as one of his worst investments. This failure does not contradict the shark mindset, it reinforces it. Investors operate on probabilities, not guarantees. They expect losses and rely on a few large wins to offset many failures. Emotion plays a role, but it never replaces fundamentals. Stories attract attention, numbers justify action. Emotion enhances clarity only after logic confirms viability. Sharks may like a founder, but they do not override data for feelings. In summary, sharks evaluate opportunities through a consistent lens. They look for real problems, large markets, capable founders, evidence of demand, reasonable valuation, defensibility, and clear exit paths. Everything else is secondary. Now pause and reflect. Which of these elements is strongest in your current idea? Which one is weakest? Investors will notice the imbalance even if you ignore it. Your practical task is simple. Take one business idea and write one clear sentence addressing each of the 7 criteria discussed. If you cannot articulate all 7 convincingly, the opportunity is incomplete. Most people never attract capital not because they lack ideas, but because they misunderstand opportunity. Sharks do not chase certainty. They chase asymmetry, where downside is limited and upside is massive. Once you learn to see opportunities this way, you stop pitching dreams and start building investable assets. That is finance in practice.